Welcome everybody to this meeting of the Economic Policy Working Group. Thanks for coming. We're very happy to have Mike Bordo speak to us today. There will be a slideshow, and the topic is very interesting: central bank digital currency and historical perspective, another crossroads in monetary history. Mike is a distinguished visiting fellow at Hoover and Board of Governors Professor of Economics at Rutgers, and also director of the Center for Monetary and Financial History. So you're going to use slides, and Mike doesn't mind if we interrupt during his presentation, but the question and answer, we'll have plenty of time for questions and answers after he's finished as well. So anyway, John Cochrane and I are co-running this, so look out. Go ahead, Mike.
Okay, well, this is great. Thanks, John and John, for giving me this opportunity. So this is not a research paper that I usually give. This is a keynote based on a keynote that I was asked to give at a conference at the Bank of England last July, and then I sort of cleaned it up and turned it into a working paper. So it's not like I have new research results to show you. It's mainly a survey of where I think we are on this issue of the case for central bank digital currency. So next slide, please. Michelle, yeah, next. Okay, good. So its topic is central bank digital currency and historical perspective. So we're at a crossroad. I see us at a crossroad in monetary history. That advances in technology, and by that I mean digitalization, has really led to the development of new forms of money. Examples, of course, are cryptocurrencies like Bitcoin, stable coins like Libra, Diem, etc., and central bank digital currencies. And the one that I like to mention is the Bahamian sand dollar, which I think is working pretty well. And so these innovations in money have resonance to early major shifts in monetary history. And so my overview of the history of monetary transformations suggests that technological change in money is inevitable. It's driven by the financial incentives of a market economy. And monetary authorities have always had a key role in the provision of currency, of outside money, which is a public good. They've also regulated inside money provided by the commercial banking system. And this held for fiduciary money, and I think will likely hold for digital money. Central bank digital currency would make monetary policy more efficient. And if the interest rate paid on CBDC is used as a policy instrument, the issue of the effective lower bound would be eliminated. And varying interest on CBDC would give you true macro and price stability. And the last point, and I'm going to go through all this stuff in detail, will have a great impact on the global economy by facilitating international payments, and it also might transform the international monetary system. Next slide, please. Okay, so I'm going to talk about these monetary transformations, and they're driven by changing technology, changing tastes, economic growth, and the demands to satisfy the functions of money. Now, money in finance has evolved with human history. It goes back, over 2,000 years. I refer to this great book by Getzman, Will Getzman, 2017. And there are three sort of transformations that I think set the stage for the current digital transformation. Next slide, please. So the first one is fiduciary fiat money, paper money. And new financial technology in the 18th and 19th century led to convertible banknotes, which greatly reduced the resource cost of specie. So I have a quote here, a famous quote from Adam Smith. I'm not going to read it all. It basically says, going from gold and silver coins to banking, okay, is a social saving. And commercial banks, as we know, originated with the goldsmiths of medieval Italy that provided warehouse certificates for the deposited gold, and that led to fractional reserve banking and convertible banknotes. But the social saving of fiduciary money that Smith talks about has to be balanced by the credit risk from potential runs. And he has his quote's a lot longer than this, but he says that too. Okay, next slide. Yeah, and the second sort of part of that of the paper money is fiat money, and that's associated with war finance and its rising costs in the early modern period, and that led to the issue of government in convertible fiat money. And the early examples that I talked in great detail in a paper we gave last year with Mickey Levy was the paper money issued by the Riksbank to finance the 7 Years' War, the Continentals during the American Revolution, the assignats in the hyperinflation. And because of all those stories, which did lead to high inflation, fiat money had a fairly bad reputation until monetary authorities learned the technology to operate credible low inflation fiat money regimes in the late 20th century. So I think, I posit that CBDC as a social saving over fiat money may be the next generation in this progression. Next slide, please. So the second transformation is well, I'll call it free banking, but it's competition in banking. And I think the record of poorly regulated convertible commercial banknotes was pretty checkered in the 19th century. It led to the case for government regulation of commercial banking and even for a government monopoly of the note issue. So I have this quote here from Milton Friedman's Program for Monetary Stability, where he makes the case for why you really need a government regulation of a paper money issue. That if you left it to the free market, that you would have indeterminate prices in all of these private money issues. There's a big debate about this, but I'm just throwing this out. So the classic case that's always talked about is the US experience with free banking. And I say the record, and this is a controversial again, is one of instability. There are others who think it wasn't quite that bad, but there were frequent failures, there was fraud. And the key thing is that the payment system was inefficient because notes circulated at discount. And I'm citing Gary Gorton's work because he did a lot of work on what the problems were. And the high cost, asymmetric cost of a multiple currency system led to an inefficient payment system. And that led to reform, which led to a more efficient banknote with the creation of national banks, which were backed by US government bonds. And then eventually that we can tell the story of the Federal Reserve. Next slide, please. Okay. But other countries, the story is similar. The case of the country banks in England was covered by a famous book by Leslie Prestel 80 years ago. Switzerland's a recent book that talks about it. The major exception is Scotland that Larry White's written about, where he argues it was successful. But again, Charles Goodhart said that was pretty special because it was an oligopoly, there was unlimited liability, and there was implicit backing by the Bank of England as a lender of last resort. Canada, a country I come from, after 1867 had safe banknotes with the establishment of note redemptions funds, and as did the national banking system in the US, but there was still credit risk of bank failures. So in all the cases, the note issue gravitated towards a central bank monopoly. And it's, in a sense, it's the information asymmetries of multiple competing currencies that led to central bank provision of currency. And so I think that the present day rise of cryptocurrencies and stablecoins suggests that the outcome may also be a process of consolidation towards central bank digital currency. And the third transformation, next slide, please. The third transformation is central banks. And they evolved to satisfy several important public needs. The first is, as I mentioned before, war finance in the 17th century. The second is an efficient payment system to correct deficiencies of multiple competing currencies. This was the case with the Swiss National Bank that was founded in 1907. And the third was financial stability, to act as a lender of last resort. And that was one of the key reasons for establishing the Federal Reserve in a sense. And this was following the lead of the Bank of England. Next slide, please. Yeah, next slide. So, and the fourth is stability in the value of money. And again, the Bank of England learned in the early 19th century to operate a mixed currency. That is, in the gold standard, you had both gold and you had banknotes, Bank of England notes, and they were able to figure out with a fair amount of effort and time to figure out how to do this, but they were able to preserve gold convertibility and provide financial stability. And other countries have followed the British lead. And the fifth is counter-cyclical monetary policy to provide macro stability. And that has been evolving since really since World War II. And there were lots of bumps in the road, but it has evolved into flexible inflation targeting based on the credibility for low inflation. So I think, again, that CBDC would follow this tradition with the interest rate on CBDC, which could be positive or negative, as a policy tool to stabilize the economy. And again, I go back to Marvin Goodfriend on that issue.
Can I ask a procedural question? Are you open for comments at this point?
Yeah, I am.
Or do you want to wait?
No, it's okay.
Okay, so I just point out one thing, and that is, in the eras that you've been talking about, where it was not technically possible to pay interest on currency, the entities, including governments, were chasing they couldn't compete through the interest rates they paid, and therefore they competed by trying to get their notes in circulation. But with modern technology, we can pay interest. So it seems to me there's just a whole difference between history doesn't bear very much because most of history is controlled by the efforts to get money in circulation. But now you have an efficient equilibrium, which you mentioned before. Now there's a presumption of efficiency because of the ability to compete on paying interest.
Yeah, Bob, I think that's a good point. But the thing is, it was the real issue. I mean, if you go back to these different stories, it was a quality of information. It was a quality of the bank issuing the notes, and the fact that the information was hard to come up with. And also there was the credit risk, the fact that the banks, even if the notes they could work out a deal, which they did. They have, like in Canada, they had a note redemption fund, which was created by the banks, and they did actually create safe the notes didn't have discounts like the U.S., but banks still failed in Canada. So the thing is, there's credit risk plus the information, which I think is part of the reason why in these different countries the case was made for central bank control. And I think that both of those elements, that second element is still there.
Oh, sure, yeah. But
I
agree with that.
Could I ask why are you referring only to central bank digital currency? I think the analogy I'm sold in the 19th century, the U.S. Treasury started issuing paper currency and said no more banknotes. We have a natural monopoly here. Why isn't it the Treasury that issues the same security we call reserves and lets every person have it? In fact, it's more natural. The central bank is only supposed to talk to banks. The Treasury can issue digital, as it issues coins, it could issue digital coins. So why do we jump to central bank digital currency rather than very liquid interest-paying government debt as currency?
But I mean, we basically do use.
Yeah, but we have this whole weird thing where the Fed buys treasuries and then issues reserves, and then we can't hold reserves, so the banks have to hold reserves. Why doesn't the Treasury just issue interest-paying overnight debt electronically transferable and call it electronic coins?
Right, but see, wait a minute.
Let's just clarify how this institution works. The Treasury runs a book entry system. It's pure digital currency. I think, John, the only thing that's missing is the overnight. They don't participate in the overnight market.
Right. Well,
and if there were a good reason to, they should.
They don't buy it back. I looked it up on treasury.gov. You can buy from them, but you can't sell to them. So overnight and electronically transferable, that's all they got to do. And we've got our government provided digital currency right there. And we don't need to get the Fed involved and the Fed worrying about undermining the banks and all the rest of it. Anyway, Mike, there's a question for you. Why are you calling it
so listen,
currency, not just digital currency?
No, okay. So first of all, I think that's true. I mean, the real question that led to in a sense government control was the question of backing and stability. And so yes, the Treasury could do it, and the Treasury in the U.S. was the monetary authority, and the national banking system did work. Okay, the problem with the national banking system was with the banks and the credit risk of banks. Okay, but in terms of the national banknotes really did work. Okay, and they had a redemption fund, but it still was a bank could fail. Okay, but you're right, the Treasury could do it. But I think in a sense, I see central banks as having a comparative advantage, and in a sense, central banks came out of treasuries. And they do some of the work that treasuries did, and I think that the Fed is an improvement over when we had the Treasury was the monetary authority in the U.S. before 1914. It's not that we didn't have anybody; they were there. So I think that there are complementarities in what central banks do, which makes the issue of money part of it. Okay, and I think that just carries forward.
Not once you're satiated in interest rates. Anyway, go ahead.
Okay.
Can I ask just a point of clarification on how much it's allegedly would increase GDP? Is that one time or per year?
Okay, so let me.
Per year would be hard to believe.
First of all, well, let me finish that slide, and then okay. So let me go back and do that slide, and I'll tell you what that means. Okay, so what I want to talk about now for a few minutes is what's the case for CBDC? Okay, this gets to John's question. Why do central banks, why are they interested in establishing it? Okay, or why are they reluctant to do it? It's the same question. And one is that CBDC would be the 21st century version of Adam Smith's social saving. And the first is it would reduce the cost of issuing and operating physical currency. The numbers come between 0.5% and 1%. This comes from the IMF. The second is that the direct peer-to-peer interface through access to the central bank's balance sheet, that it would reduce the monopoly of rents earned by commercial banks and operating the payment system. And this is somewhere between 1% and 2%. And I cite Andel Fadl's work, but a lot of people worked on that. Okay, the third one comes from this paper. This paper uses a model, okay? And these are simulations from the model. And that, as you know, that's based on what the assumptions are and the parameters. That's where they come up with that. It's not per year. It's a social saving. It's like what Smith talked about. It's just the saving of going from one type of money to another.
Okay, so it's one time.
Yeah.
So it's a minute percentage of the present value of GDP.
Yeah. It's
okay. I just wanted to be clear because 3% is a shocking figure.
It is. Yeah. The second, next slide, please. Okay. Yeah. So the next thing is that the next issue is that the digitalization has already reduced the use of cash to very low levels in a number of countries. And the ones we always hear about are Sweden and Norway. And so a CBDC could really give you a payments media, which has all the attributes of cash and be safer, but it also could allow central banks to better perform their monetary policies. I mean, in those countries, they're worried that they would have a hard time conducting monetary policy without having something. The third, we're not, US isn't there right now. Third point, which is an issue that's been pushed a lot, is that CBDC could improve financial inclusion for underbanked groups. And this is especially important for LDCs. And this is one reason why the Bahamas did it and why a lot of other poor countries are doing, because people don't have access to banks. And it also could be used to make fiscal transfers. And there was a whole discussion about helicopter money during the pandemic. A third argument is you could head off the threat to monetary sovereignty from stable coins, because stable coins could also satisfy the functions of money. And we'll get onto that in a few more minutes. And the fifth one, and the one that the central banks are obsessed about, is that it would provide a secure, reliable currency free from the dangers of fraud, hacking, money laundering, and all that other stuff. So that's one of the things that the central banks are really focusing on, is that number 5. So those are the reasons why central banks are doing this. Yeah.
So on number 2, the underbanked groups, why is the private sector unable to provide something efficient? Well, because it's so heavily regulated. So it's not technological that the banks can't do it. It's the lack of competition and the immense amount of regulation put in, which kind of goes to number 5 as well. One of the attributes of currency is anonymity. And I hope you'll comment on this is the hard nut of CBDC. Are we going to be China, where somebody in the government watches every single transaction you make? Or if not, how are we going to avoid that with a CBDC?
Yeah, so I mean, I'll get to that later, but basically, that's why I make the case, Andy, Levin, and I make the case for a public-private partnership where we get the banks to do it. But they are the conduit by which the CBDC gets to.
So 100% backed payment services, deregulated payment services backed by reserves is where you're going.
That would be a way of getting at that issue. But their issue is going to look, the issues there, the issue of anonymity is the case. It's a problem with bank money. I mean, to get a bank account, you got to give them a lot of information. The information you would have to give for CBDC would be the same.
This is an inevitable tension, because if you make very cheap transactions anonymous, then nobody pays taxes and ransomware and hackers go nuts.
Yeah.
If it's not anonymous, then we become China and you lose absolutely every liberty you have. So this does seem to be the central design.
So I mean, again, this is going to come up in a minute or so, maybe whenever we get there. But so there's a trade-off between sort of these tokens, which are anonymous, and the problems they can lead to, and bank provided, account provided currency, and so there is that trade-off. It seems to me, it's like I'm throwing out the ideas. It seems to me that this is a design property that could be worked out. Okay, and we know that's one reason why there's such pushback against CBDC in this country, is because of China. But it seems like something could be designed which has, you can satisfy all these properties of security that is obsessing all the central banks, and yet give some privacy so that the government is not involved in watching every transaction you do. But I see this as something that can be worked out technologically. I don't know how to do it, but I think there's a trade-off here. So you don't get in a corner solution where you say, well, okay, because of that, we really don't want to do it. I think it's a way of trying to figure out how to do it.
I'm agreeing with that, but that's the design question. Secretary Yellen proposed the banks report every transaction over $600. So the tension's already with us.
Yeah, that's next. Okay, so next slide, please. Yeah.
Isn't there also an issue of the capability of the government to do this? Especially if maybe the central bank is more likely to be the Fed's likely to be a little better, but all the experience we have in fiscal transfers and anything dealing with the low-income population is a massive amount of fraud. And we start doing stuff electronically. California had $30 billion of fraudulent payments to Nigerians and people in jail for unemployment insurance claims, while there are 1 million of them backlogged. So I think we shouldn't just assume automatically, given how people are going to get signed up for this, et cetera, et cetera, et cetera. There aren't going to be lots of issues to be dealt with there, just because the Fed's doing it even worse if the Treasury, probably even more if the Treasury's doing it.
Yeah, no, I agree with you. I agree with you, Mike. I think these are the issues that have to get worked out. And I think that
we ought to talk some more about China, because China has a very successful system, putting aside the surveillance question, which I take, I agree is a problem, but just from the point of view of private monetary system, their private monetary system has just swept through China and made transactions occur in private money market funds, and a transaction consists simply of debiting one account and crediting another. There's no involvement of the government in transactions, except those a small number that move back and forth between these monetary units. The government performs its central function. You haven't really talked about this, but there's a central function of government, and that's to provide the unit of value.
Yeah.
And that's unquestionably a natural monopoly. And you had that nonsense quote from Milton Friedman. He was just confused on that point, because he thought that each private currency would be denominated in its own units, but that's not the way it's ever worked anywhere.
Okay. First of all, I was going to talk about this stuff right now, which is it is a unit of account. This is coming up, unit of account. And China, I'm not an expert on China, but in a sense, the Chinese are learning from the success of Alipay, and they have worked this out, and so the CBDC there is built upon that technology. But it gets okay. Let me.
But it's totally unnecessary. All it needs is to have the UN be a unit of account, and have it would play the role that gold did under the gold standard. But the rest of it can be completely private, and they showed totally successfully how it can be private.
Okay, but again, that's a variation on the public-private partnership. So, but the basic case for CBDC in this slide is it's defined as an asset in an electronic form, as it serves the basic functions of money. Okay.
Well, but you can divide that. I think you're confused.
No, I'm not
completely
confused.
You can completely divide the function between sponsoring a government-sponsored, government-created unit of value, and then have a private transaction system in which accounts are denominated in the government's unit. And that separation can be achieved in many different ways, but it's just not correct to say that the central bank has to be involved because it's money. That's a misunderstanding.
And CBDC is inherently a proposal that every time I pay Bob $5 for a cup of coffee, that routes through the Fed's computer, as opposed to our banks netting something, and it's a claim on something that's off at the Fed, seldom used.
Right. So, but getting back to the discussion that led to Bob, who was ahead of the curve, is that that CBDC provides the functions of money, and it can do so more efficiently. That's in a sense what we're saying. So
yeah, but the Chinese experience completely challenges that. It's just the wrong place to start analyzing this issue.
But if you look at the case of stable coins, which is what we're talking about, and I'm going to talk about, okay, that they can separate the functions of money, but there's still a problem of the stable coin issuers. It gets back to the issue of credit risk from the beginning I talked about.
Just a 19th century bank.
Yeah. So here, this slide, the takeaway from this slide is there are three functions of money, and then we argue. Next slide, please. I argue with Andy Levin that this can be done more efficiently but it can be done with a CBDC. So a CBDC is just taking what we have now and making it electronic. Okay, and the first one is instant clearing, second is interest bearing, and the third is it just facilitates the planning of economic actors. So that's the case.
Yeah, but none of those things address the issue of whether it should be public. All those, as well. Can we talk about Chile too? Because Chile has extremely successful financial system.
Sebastian, can you hear me? Sebastian has a question. He knows about Chile.
Good.
I know a little bit about Chile. And we can talk about that, Bob. You wrote a paper on the two currencies in Chile a long time ago, which was quite interesting, actually.
I haven't forgotten.
But let me go back to something that we were discussing a little earlier. I want to go back to basic monetary theory and what Milton used to say. And one of the building blocks is that there is such a thing as a stable demand for money. And when we say that, it is for local money at the time. Now we're going to have a whole bunch of CBDCs, and I could have them in my iPhone as I have my wallet right now. Every time I go to the supermarket, I put my wallet to the thing, and it gives me an option whether to use my Visa, my MasterCard, my American Express, or my debit card. Okay. Now, in the future, Mike, I can see that, let's forget about being anonymous or not, or let's assume it is. I can have the same, but it could be loonies, Kiwis, Aussies, USDs, euros, sterling. And the demand for money in these countries is going to be jumping all over the place, making, instead of monetary policy easier to conduct, much more difficult. Now, that's only the introduction to my question. The real question is Argentina, which now we're getting to close to Chile, where the Argentines, once this comes up, will never again use the Argentine peso, right? Right now, inflation in Argentina is 60%. Why would anyone use pesos? And then they will decide on the spot whether to use Canadian dollars or, and monetary policy and currency substitution. Mike, you wrote a very early paper, very nice paper on currency substitution. It's going to be a big, big issue. And I think it's going to create a lot of havoc in the global economy, especially in the smaller countries.
Yeah. I'm going to talk about that if I can get there. I have a whole section on that. Okay. Yeah. And thanks for mentioning my old paper. Okay, so the argument is that CBDC could satisfy these functions. So let's go to the next slide, please. So the question is, and again, this has been asked already, is how do you go forward on this? And there are a number of design questions. So one is, should CBDC be wholesale or retail? And in a sense, improvements are already underway in the wholesale clearing mechanism that moves them in the direction of instant and virtually costless real gross time settlement. So the real issue is over retail CBDC. And should central banks provide digital currency with all the features of cash, or should it be left to the private sector? And the public good aspect of currency argues strongly in favor of either direct provision or close supervision and regulation by the government. Next slide, please.
Is that just a premise, or how?
I'm just saying that follow. I'm throwing that.
I would take very strong exception to that proposition.
Okay.
I do, but Manny's been trying to ask a question for a while. Got to jump in here, guys.
Oh, sorry about that. I was just going to provide a little bit more information, I think, around 2 points. But Mike, if you want to finish, I think that your next 2 slides, I'll just raise my question then. Sorry about that.
Okay, so then the question is whether it should be token-based or account-based. And the argument for tokens is they're most cash-like and they would be anonymous, but the downside is they could be stolen or lost or used for money laundering, et cetera. So the account-based are viewed as more secure, but at the cost of some privacy. So that's the issue. And they could be practically instantaneous and not costly.
Aren't tokens much more inefficient computationally?
Yeah, well, that's part of it. It's yeah. So next slide. Yeah. So then this is the issue and since we've already talked about this, is accounts at the central bank or private financial institutions. And you could have it physically, you could have, the technology is there to have accounts at the Fed. And we had those in history. We had those at the Bank of England, Banque de France. But the private sector has a comparative advantage at financial innovation. So in advanced countries, two-tiered or public-private arrangements are likely preferable. And you could have these designated financial institutions could offer CBDC accounts to the public, and they could serve as a conduit for the central bank. And this goes back to Tobin, wrote something about this a number of years ago. And you could have the private commercial banks could hold a corresponding amount of funds in segregated reserve accounts at the central bank. At the Bank of England calls these payment interface companies. It's very similar to Henry Simon's and Milton Friedman's Chicago plan, and separating banks into a narrow bank and an investment bank. But there are lots of other arrangements you could come up with where you use the know-how of the private sector, but yet you have the central bank is providing the safe unit of account. So the next slide. Yeah. Well,
is there any reason why these institutions couldn't be money market funds? It seems like we have a very successful legal system under the 40 Act that tells you exactly how to solve the major problems that you've been talking about, in that a money market fund is run proof, and it's the way to go. So it seems to me the big player in this market you're talking about should be Vanguard, not a bank.
He's creating a money market fund, basically. The money market funds must be legally regulated against payments, because otherwise Vanguard wouldn't take 3 days to send something to my bank.
Oh, well, that's the kind of friction that's the friction that China has overcome. You've got two gigantic money market funds who can do transactions with finality instantly. There's no reason why Vanguard couldn't do that.
If we just remove the restrictions on federal money market funds from accomplishing electronic transactions, we're done.
Anyway, Vanguard can certainly do daytime transactions.
They don't. No,
they do for
two or three days
me.
They don't
for me.
Axel, can you ask Axel?
Yeah, hi. Yes, I just wanted to bring in a point you raised that, it's possible for individuals to hold accounts at the Fed directly. Maybe. The concern, I think, in practice comes in that you need to know your clients. That's kind of the basic principle of US banking. And in the work we do in our business, one product we once developed, we even got a patent on the process. We built an interface between institutions and retail, and it was absolutely non-trivial. Institutions are petrified about touching money of individuals because they don't know them. Obviously, a bank knows the customer, but in general, they don't need them. So if retail were to have an account at the Fed, well, you need to authenticate them. And it becomes, obviously, it's going to be as fancy as the real ID at the DMV. Going to make it very difficult to hold an account. And so while it's technologically possible, I think the bureaucrats will see plenty of hurdles before we go down that road.
It's very strange that China solved this problem. And believe me, China's full of dishonest people. But they're too big, gigantic, by far the largest money market funds are in China, two of them. And it works. It works.
This is a great point. The Fed having to implement its own know your customer regulations would just be hilarious. Okay. And it might be useful for them to try.
Right, but that, again, I think it's technically possible, but that's the reason why you want to have a public-private partnership, because banks have figured out how to do this already.
Do you think there should be a public-private partnership in mutual funds?
No, between,
Does the government have to intervene at Vanguard?
look, it doesn't have to be banks. Okay, there are some entities out there that could do it. Okay, maybe it could be mutual funds. The question then is, let's go back to what happened in the GFC with the break the buck. It's like you gotta have something that could prevent any credit risk.
That's because they
And
didn't
this is-
follow the law embodied in the 40 Act was violated by the SEC in failing to enforce the proper valuation of the shares in a way that departed from the optimal design. But that was entirely an artifact of poor exceptions to the beautiful design of the 40 Act. The 40 Act would specifically prohibit what caused those runs.
So just, so Manny and Steve have questions. Manny and then Steve, please.
So I wanted to make three quick comments, and they're primarily from the perspective of someone who works with a lot of folks, smart contract engineers to really implement systems that look like this. So I think my first comment is really that in terms of financial inclusion, there's a very poor argument for this, I think, for CBDCs, because even in the United States, the digitization of online transactions and so on is driven by the private sector. Bob Hall made the point about this being the case in China as well. So it seems like digitization is just driven by private sector incentives rather than anything that a central bank might do. The second point is a little bit more technical, which is really about the account versus token-based system. So it is true, I think, to John's comment that token-based systems are computationally more intensive, and Bitcoin here is the prime candidate. The issue is that the trade-off for an account-based ledger that's actually not that computationally intensive, it's really a spectrum between kind of the reversibility and mutability of the ledger, right? From immutable to fully mutable. The problem of switching to an account-based system is that you basically end up with just like 5 node controllers, right? So it's basically a database that exists on 5 computers. And at that point, it's just functionally equivalent to just any regular database today, right? Like what Amex has, what any bank has, right? Where they can just manipulate it at will. And so it's not clear to me that an account-based system would be meaningfully different from any sort of digital money that we have today. And then my third point was really around the credit risk question, which I think Bob Hall for bringing up the point about 2008. At least for stablecoin providers today, the main risk really accumulates at the fact that they have assets in traditional markets and then they're issuing digital tokens. Where they to hold digitized assets on a decentralized ledger, this question about proper valuation and transparency and audits would be kind of trivial, right? It's trivial to audit smart contracts and see the value of the assets that are held there. So in some ways, I think that reduces the information asymmetry, I think that Mike began the presentation with as being kind of one of the central dilemmas. So those are kind of just the 3 things I wanted to share.
I'll take them on board.
Steve and then Andy.
Yeah, so I'm less sanguine about how a movement towards a central bank digital currency will work out, and suggested by many in the remarks. And I want to offer a few reasons why. First, even if technically we as economists know how to design a good system, there are big political economy challenges to doing that. The banks and the credit card companies are not going to willingly sacrifice the enormous revenues they generate from interchange fees and from access to cheap funding through traditional sources of deposit. So the idea that even if the Chinese figured it out doesn't mean we'll get it right. That's the first point. Second point is, I want to go back. I thought Sebastian made a really important remark about currency substitution. If we do move this way towards successful central bank digital currencies in some countries, there are a lot of countries that are going to see their seigniorage revenue evaporate because nobody's going to want to transact in their currency. And that creates a bunch of fiscal problems for those challenge countries, but also international problems. And then the third thing I would point to is I go back to something Mike said earlier. He put it in a very mild mannered way. His language was something like, well, eventually central banks figured out the technology for achieving low and stable inflation rates with fiat currency. Yeah, that only took decades. So I think this notion that we can sit here and maybe we could design a system that would be much more efficient in terms of the current payments mechanisms. And I've completely set aside the privacy issues, which I share the deep concerns about the risks there as well, even under public-private partnership systems. So all this strikes me as reasons to be very cautious and incremental in the move towards in this direction, rather than, yeah, I appreciate the efficiency arguments, but I just see lots of pitfalls along the way.
Yeah, so look, I agree with you as the political economy story. I do think this is a problem, and this is why it's not going forward. This is one reason. That's definitely why would the banks want to give up their rents? But that's what the public. If you did the public-private partnerships, then they would get something, but they might still lose much of the rents that they get. The issue of currency substitution, I'm going to mention that. I was going to mention that at the end, and I agree with you about that issue, and I'm going to say something later. So that's all I was going to say.
Isn't there also an issue related to what Bob raised earlier about basically China's currency, whether it's the People's Bank or whatever, sweeping the world, and that may not be in our economic, let alone geopolitical interest?
I was going to say something about that too. I really doubt that's going to happen, but I'd like to hear Andy.
So Mike, as you know, that I favor the more competitive approach of having the private sector, run these payment systems. The reason we got to this point is through innovation, and the public sector doesn't do innovation, and so we may be behind the curve in the future if we don't allow a lot of this to happen amongst the private sector entities running the payment system. And of course, there was the issue about the monetary authority getting involved in social policy of providing, smartphones to little kids, and all these social issues would be very confusing. But my big point in this whole literature, when you start going down this road of CBDC and setting up a big computer that does all the transactions costlessly and in no delay, the question is, how does the monetary authority control the interest rate? So in contrast to the traditional story about money, the way central bankers think, and this is around the world, think about the way interest rates are determined is the overnight interest rate is determined by the supply and demand of clearing balances. So we have legal restrictions that don't allow sort of immediate clearing on everything. As you go towards CBDC and technology, those clearing balances get smaller and smaller for the whole set of transactions that go on in the economy. So it's like while the tail of the dog seems to be, wagging the dog, now it's the tip of the tail that's wagging the dog as you get more of these payments outside the clearing balance constraint that the Fed and other central banks impose. So how do you set interest rates in your system if the friction of clearing balances is no longer the wedge that central banks use? What is the friction that's going to allow the central banks to establish the price of the currency?
I don't know. I've always thought it would be just moving us back to something like we had before the global financial crisis.
No. The answer to this question is simple. It's you pay interest on reserves.
Exactly.
That's what you're doing. That's what we're.
That's what.
Okay,
Yeah, okay.
but-
You made it sound like it's an history.
And that's what you change. You change the interest on reserves.
Yeah, but that
That's how
doesn't work
monetary
anymore.
policy is.
But you don't need a MV equals PY and a monetary friction. We haven't been thinking that way for 30 years.
Yeah, exactly.
No, but that's not how, okay. I mean, that's not how it works. I mean, basically there's a friction which allows the Fed to set the interest rate, which is no private entity can clear the last set of transactions in the economy unless it's overnight. And so the central bank has a monopoly on clearing at the end of the day, as all central banks do.
Say
And
government
that
debt, come and get it
traditionally
at 3%.
Okay,
I don't get it.
I mean,
Okay.
I throw it out as the way central bankers think.
Look, I want to finish. I want to finish this. Okay, so to cut some corners. Okay, so I told you what the case was. Okay, now I'm just telling you, I'm going to talk about central bank digital currency and monetary policy, since we've already talked about that, and Andy Levin talked about it here at Hoover. So you use the interest rate on CBC, CBDC as a policy tool, and you could go negative or positive, and this could be a problem. This could get rid of the effective lower bound. Okay, and it would also obviate the use of quantitative easing and forward guidance. And it could greatly simplify central bank balance sheets and move you back towards a bills only policy. And then next slide, I summarized some of the literature out there on other ways that you could have interest on CBDC, could help move you back to a floor system. It could improve the transmission mechanism. It could act as a lender of help facilitate acting as a lender of last resort. And what I talked about last year with Andy is you could actually provide a price level targeting rule based on a Taylor rule. So these are the arguments. And next slide, I want to get to, because it's not that much time, I want to get to this one. Okay, because a lot of these issues came up about the open economy. And the first point is that CBDC could greatly improve cross-border payments, which at present are done through an elaborate network of correspondent banks, and it's very costly and slow. And so you could do with digitalization, payments could be done almost instantly. So in a sense, it could create a social saving like the first transatlantic cable that was laid in 1866. Now you've got these stable coins, and they've already been brought up here in the conversation too. So they promise to arrange peer-to-peer payments through their established networks. Okay, but the problem here is, and again, it was mentioned, is that we're stable coin providers to dominate these arrangements that could threaten monetary sovereignty and be subject to credit risk. Next slide, please. Okay, so so that makes the case for some regulation or maybe a CBDC. But then you still got the problem of if you have sovereign CBDs, this gets back to Sebastian's point, then you got to make arrangements for interoperability between them. So some of the stable coins, they promised to do that through their networks. But again, if they do that, then they threaten monetary sovereignty and they're subject to credit risk. So again, the case is made for some regulation or maybe a CBDC. But even if you have a sovereign CBDC, you need to make arrangements for interoperability. So this opens up that a can of worms that were mentioned above. Next slide, please. Okay, so again, this was raised by Sebastian. A system of CBDs which link together the monetary and payment systems of different countries could lead to an amplification to spillover effects of domestic monetary policy on other countries. And this is related to the work that John Taylor's done, and I did some work on with Catherine Schenk on this. So that you could mitigate that by following by either coordination or following rule-like policies. But there's still a problem of the small open economies could face threats to their monetary policy independence from shocks in larger countries working through uncovered arbitrage between the interest rates on CBDC, and that could amplify the exchange rate movement. So in a sense, you're solving a problem here of efficiency, but you've got these other issues that open up.
Let me interrupt very briefly, Mike. Wouldn't this just encourage the Argentine government, the Peronistas, to impose all sorts of controls or even greater controls on international mobility of funds? And with new technology, that means going China. I mean, it means getting into your iPhone. And so wouldn't this lead to that kind of potential problem?
Sure, you could get that. Argentina could do anything.
Yeah, that's right.
We always think of Argentina as a country that's going to, whatever you think of, they're going to screw it up. And I agree with that.
No, but so can the US. This is a really important point. This CBDC enhances the government's ability to put in capital controls, to defund industries it doesn't like, pot growers, for-profit universities, oil producers. We can shut you out of the payment system. So that's why the anonymity point is really central.
Right, and that's why you want to go for the public-private partnership. So you don't want to set the Fed to do this, and you can work something out that does this. You can be this is an arrangement that has to get worked out.
Michael,
Okay. Yeah.
Mike, you have 6
can
slides.
you
and
name
6
3
minutes.
public-private
6 slides to
partnerships
keep
that have
it.
ever worked?
Yeah. Okay. Okay. Look, that's it. The last point I was going to make on the international. Okay, you can turn to the next slide. The last point is that currency substitution, which sometimes is called dollar digital, could threaten dollar dominance. Okay, so if, for example, you had stable coins, okay, and they could separate the different functions of money, okay, and the networks are really extensive across the world, this could compete with the sovereignty of a dominant currency. Okay, and so this could challenge dollar dominance. This is an issue that's come up a lot. Okay, so then the question is, about the dollar itself. The dollar provides all these services, and it's evolved over time because it's done a good job. It means that you could probably not have this happen, but this is a risk. And this is a reason why people at the Fed are worried about stable coins. And they're worried about China for this very reason. Okay, so this is an argument for why they want to do it. Okay, the last thing I wanted to say, so that I don't run out of time, is to just tell you what the lessons were from this paper. So let's go to next slide, please, 25. Yeah. Okay, so look, yeah. Okay, so anyways, there are also issues of information asymmetry associated with international stable coins, and that's a good reason for, in a sense, having a CBDC instead of stable coins doing it. Okay, let's go to the next slide. I want to just finish off. There are 4 lessons that come from this talk. Okay, first thing is the technical change in money is inevitable. It's driven by the financial incentives of the market economy, and you can trace it through history. And that's what the first point. Second point, next page, next slide. Yeah, is okay. This is the one I'm running into pushback, but government has a key role in the provision of money. Outside money is a public good. It's necessary for the central bank to provide it. And I'm arguing that you can go from fiat money to digital currency, and that makes the case for CBDC. Third point is, next slide, is that CBDC can revolutionize monetary policy if you use the interest rate on CBDC as a policy rate. Okay, and it can provide a more efficient transmission mechanism. Fourth point is, yeah, it's a global innovation. It's going to revolutionize international payments the way that the first Atlantic cable did. But it's also going to lead to this problem of currency substitution. And that's going to require some kind of international monetary cooperation. Also, that stable coins and CBDCs from different countries are going to challenge the international monetary system. And so the question is, so I think the fundamentals that lead to currency domination are unlikely to change. Okay, and if there are forces that are changing them, that digitalization will accelerate them. And that's exactly what happened in the 20th century when the dollar eclipsed the pound. And I conclude by saying digitalization in money and finance is the future. And here, I guess nobody agrees with me, but I think central banks need to be part of it. They need to work alongside the private sector to provide digital currency to effectively fulfill their public mandates. Okay, so I finished.
So there's a little more time, no? We can,
Yeah, got
Go ahead.
we could disagree some more. So
Yeah.
on this international issue, that's an issue, the international use of the dollar, which is very extensive, in especially in denominating bonds, is strictly an issue of denomination. So it provides a unit that people can write contracts with, and they like it because historically, at least maybe not recently, but before that, it was stable. So the dominance of the dollar as a denomination unit for international transactions depends entirely on its value as a unit. It doesn't depend at all on how it's achieved and you know what the IO analysis of the way it's done in the U.S. It depends entirely on what the dollar will buy.
Let me add to what.
So you don't need anything.
I would add
except
to that you need thick liquid markets with very thin bid-ask spreads and options and futures for the.
Okay, but that's a result of that.
Yeah,
That's an endogenous variable that follows upon good performance of the dollar.
Also,
So
one-
let me very quickly add to what Bob just said. The Chilean system in Chile, the second currency, the UF, plays exactly that role for contracts. You cannot pay with UF, but you can write all sorts of contracts. I have an apartment in Chile, which I rent in UF. So it's adjusted every month.
Could I interrupt for just a second? Just let me define it. The UF is enough pesos to buy the Chilean cost of living bundle. So any contract that's written in UFs is automatically price level indexed.
Yes.
And it's amazing. And the weird thing is that nobody knows about it. You know, there's only 3 economists in the world who American economists who know about it. And it's never been copied. The only country that's even, I guess Brazil and Argentina both thought about it and rejected it. But it's just completely unknown to economists. Yet it's a completely successful institution.
If I
It
could
gives
add to
automatic
this-
indexation.
Well, we can have a whole seminar on that because they are thinking of getting rid of it.
Well, it's run by Chile. It's been taken over by the commies, right?
Yes.
If I could add to that,
Okay.
now that we pay
Naturally.
since we're going to pay full interest.
That's a
on
20th
digital
century word.
dollars, since we're going to pay full interest on digital dollars, the need for national currencies, you don't get any seniorage anymore. So really the only reason to use one currency versus another is optimal currency areas or what you want your prices to be sticky and sorts of things. So it's not so
Okay.
obvious that you need to have all this international coordination to buttress every country having their own currency.
No, John, we should talk about that further. I'll convince you that's wrong. It's the value of the dollar is not one of transactions, it's one of denomination.
I agree entirely, exactly.
Okay,
And
so
Mike was saying every country, we need international agreements to keep countries having their own currency. But there's no reason for that because there won't be any seniorage anymore. You're paying full interest on currency. So I'm exactly in the Bob Hall world here.
oh, well, okay, but this idea that
Right? It denominates. And most of what Mike said.
people don't transact in dollar bills.
No, but
You're
what Mike
talking
said
about an
is
argument about
consistent
dollar
in
bills.
the end
It's
with what
silly.
you two agree.
Anyway, we can
You don't
talk about it later. You're
Well,
wrong.
you two agree, but you don't know it. Most of Mike said was consistent with the digital dollar can be the unit of account, and you allow derivative transactions in that unit of account as they are financially useful. So you don't really disagree as much as
That's right. Okay, well, I'll convince you later that you're mistaken in one particular way, but we don't need to use it any more time here.
Mike Bordo, do you have any further
Well,
comments?
I was very entertained and I really appreciate some of these comments and it's great. No, really, it's good to get the pushback. I suspected I would, and I appreciate it, especially Bob Hall.
Mike, have you thought about institutional restrictions to make sure that the public-private partnership you envision remains that the public is cordoned off to do what the public needs to do and the private is left alone? Or are you worried about it encroaching and generating all the horrors that John Cochrane envisions?
I guess
I mean, Stanford has a great example of this. We decided to merge our hospital and medical center with UCSF. And make all these savings, could be really efficient. I tried to prevent the president of Stanford from doing it, saying this is going to be a disaster. And he went ahead and did it, saying, I kept saying, you've made Stanford into a public institution, even more than its Medicare billing and all that stuff is. Said, no, we've set up a private organization here. Warren Hellman's written the contracts. We know it's just going to be private. They went forward, and 1 week after it happened, they tried to close a tiny hospital that was losing a lot of money in San Francisco. The people screamed to their representative in the legislature, and the whole thing blew up in their face, and eventually was dissolved 6 months later. So, you know, saying something's a public-private partnership always makes me nervous that it winds up being public when you want it to be private, and private when you want it to be public. So
I mean,
I'm just curious if you thought about that. The distinction.
Yeah, but there have been successful public-private partnerships in history. I mean, one of them right now is the Federal Reserve System, which is being greatly challenged over the issues of governance, but that's how it was set up.
No,
and it worked pretty well. So it you know, and I'm sure we can look through all across the economy and find them. So I think it's a matter of design, and that once you decide that you want to go with this technology, you can work out the ways to do it.
Yeah, I'm less concerned about the techniques of doing it than I am about restraining the public side from encroaching on the private side.
Yeah, I think I agree with you. So thank you.
Okay, Mike, thanks very much. We've got us all thinking and talking at the same time, which is terrific.
Okay.
No, sir. It was
Thank you.
great, Mike. Thank you.
Okay.
Mike, that was great. Thank you.